Good morning, folks, and welcome back to Almus Market Mornings. We are once again going into the weekend. This time, just like every other time, there are mixed signals for us to interpret. On one hand, there seems to be conversation around a possible peace deal. The first round seems to have been rejected by Iran, though US has paused attacks on any energy-related Iranian infrastructure for some more days. On the other hand, is the troop deployment around Middle East, with some fearing a ground troop deployment soon. That would possibly be a next round of escalation. Given all of this, markets are generally carrying less of risk. Dollar index trades slightly below 100, as it would seem it's biding its time. Good morning, JK. How are you seeing the market positioning going into the weekend? Any feel on whether there could be an escalation this week?
Good morning, Swaraj. Market is definitely positioning itself on the defensive side. Those assets which are vulnerable to further escalation have been sold. And among the safe havens, dollar only has retained the status while even gold has been sold. Treasuries have been also sold on perception of higher rates. In fact, the 2-year US bond yield is now almost pushing to 4%. And significantly, it is higher than the US policy rate, US Fed funds rate by about 20 basis points. It's a very significant movement, and indicates that market now believes a Fed rate hike is on the cards. And the yield on 2-year and 10-year yields bonds both closed at multi-month highs yesterday. Odds for a rate hike is now higher than that for a rate cut. But of course, both are less than 50%. But for a hike, it is 16.5%. That is in June. And for a cut, it is 0%. Although, everyone knows that this expected inflation is more a supply-driven factor rather than a demand-driven push to the inflation. However, the central bank will remain in a very difficult position because while it is not a demand-driven inflation, and economy already showing, particularly in the US employment situation, softening, responding to higher inflation number led by supply chain issue will be actually further downward impact on the growth. And that's what they would be worried about. Definitely a stagflationary situation that is evolving. So that's, I think, something that the market is taking note of, which way the Fed will lean going forward. There are also some theories that say that because of high indebtedness of the US, with interest costs pushing more than 1 trillion a year, the debt cost or the finance cost on servicing the debt may be one priority that they will follow, ignoring the inflation if it is seen to be transitory, particularly related to war. So that's the overall situation. In fact, its situation is not just unique to US. Even in Europe, the USCB president has said that the war shock has given rise to large and possibly persistent overshoot of the inflation target, and some measure of adjustment in the policy could be warranted. Now, German 10-year yield is now well above 3%. The UK 10-year gilt yield went above 5% as well. So there is an overwhelming fear of interest rate hikes, and even the war situation, along with the oil price spike, has been the major factor behind these. And we already had talk about sticky inflation in the US, and this has only just intensified. Now, on the war front itself, Trump has tweeted that at the Iranian request, he's pausing the destruction of energy plants by about 10 days to Monday, the April 6th, and talks are ongoing. Now, this is despite Iran's earlier reactions saying that no talks have been held, no negotiations are going on. So markets remain skeptical. Even though Iran in the latest statement said that they have received a proposal conveyed via Pakistan, but their assessment is that it is one-sided and unfair and serving only US and Israel interest. And there is still no arrangement for negotiations, no plan for talks appears realistic at this stage. Uh, and one more thing that is worrying the market is the relative attacks reducing recently, maybe a calm before the storm. While most of the statements may be posturing, markets remain cautious and fearful of a sudden escalation, particularly in view of US sending more marine and airborne troops to the region. And worryingly, some analysts apprehend that it could also be a prelude to a large assault to take over the Karg Island, where the 90% of Iranian oil exports go through. And that is seen to be a strategy or as a leverage to force Iran to open the Hormuz Strait. So a lot of uncertainty, a lot of theories, a lot of possible strategies that market is thinking about. So it's a very uncertain situation. So the market is justified in taking a cautious stand. As far as the dollar is concerned, it's been hovering in the range, continues, particularly against the major currencies, but some EMs have taken a hit. Commodity currencies have also taken a hit, like Canadian dollar and Australian dollar, because of perception that eventually this can lead to a slowdown in the growth and demand destruction. So that's one thing that is being seen. Yen, I watch very closely because it's nearing 160, the psychological level where possible intervention can happen. Japanese finance minister has, in fact, come out and said that they will hold a G7 finance ministers online meeting, and there will be decisive decisions will be taken on forex as well. So yen is something that we need to watch out also in the coming days. Of course, yen has not only been weak overall based on US Japanese fiscal flag fiscal profligacy, but also because the oil has been a major negative for the economy. So G7 currencies are, while they are currently in the range, I think the upcoming events in the war front, as well as what the monetary policy in US will do, will hold a lot of influence on them. As far as the rupee is concerned, 94 has been clearly breached as far as the offshore market is concerned. However, that's not likely to retrace much, even if there is an intervention, because we have the month-end pressure still. We still have 2 days for the month-end buying. Reportedly, a lot of offshore or NDF maturities are leading to the demand in the USDINR. So we could well see the 94 in the domestic market as well. Yes, I think move from here on could be somewhat gradual, because we have almost moved one way in the USD-INR, but at the same time, the challenges facing Indian economy and the currency have not gone away. We still have the negative flows from FIIs, and the deficits are set to increase going forward. Yeah, I think the war and the oil price will hold a lot of sway over the Indian rupee in the coming days. But eventually, market is likely to target the psychological 95 level if things don't change for the better. Thank you.
Thank you, JK. And yeah, I think we will have one eye out for the war going into the weekend. Um it's a mixed bag of sort of updates. From the war front, it seems there is a defensive positioning that markets are watching out for any possible kind of escalation, surprise escalation that might come in. So that kind of posturing is being seen. But otherwise, as we have been indicating in the past few episodes, what's building is a picture of rate hikes across the world. And Fed June rate hike probability is now at 16%, which was, earlier not even thought of, because around December meeting, the general expectation was that the Fed will cut once or twice. So things have really changed on the side of monetary policy from the Fed, Bank of England, the European Central Bank, and in fact, some say even for India. There is that scenario changing on the monetary policy front that's keeping the yields sort of elevated. So these are the two stories. We will continue next week with a fresh round of updates. I think Monday is the last working day of the month, so we will see some more action on the markets front and especially on the rupee. So do keep an eye out for our episode on Monday. That's it from
So
us.
daily, monthly, quarterly, and yearly last
Absolutely,
day.
absolutely. It's a big closure. It's a big closure. Let's see how markets move then. Thanks for listening. We will
Thank you.
catch up on Monday.